Hi, welcome to Market in a Minute. So we believe that if Trump could get this deal done with Iran or resolve the problem in other ways, then inflation is going to come down because oil prices are coming down and the 10-year Treasury is going to come down. All right, that's going to expand out the markets. So we've been talking about this for a while, that the rest of the markets will probably do better than what they have been. So where to look? We think that the healthcare area, drug stocks, biotech, medical devices look like a really interesting area. But before we do that, we want to review what happened in big tech last week, talk about this big hedge fund that had to liquidate, and then just FYI, we covered our hedges last week, and I'll walk you through that a little bit as well. So before we go on, I just want you to understand that these are opinions of myself, not my firm. We're not trying to solicit you in any way. There's no solicitation off this email. It's just hopefully informative and educational for you. So the market update, we've gotten earnings reports now from 2 weeks ago from Google, and then last week Meta, Amazon, Microsoft, and Apple. And they were generally good, right? Google and Amazon, big growth, but the problem is that they have negative free cash flow. So it kind of gives us a little bit of pause. Instead of jumping up and down and buying these as they dipped, we just want to hold on to them and get a nice return, but not be real aggressive about the stocks. Microsoft had a good quarter. They spent a little bit less on capital spending, and as a result had very nice free cash flow. So that was better than the other two guys in terms of cash flow, but it was still down 23% year over year in terms of the cash flow. Meta missed badly. I mean, this is a self-induced strategy, miss. Their quarterly expenses were up 55%. So the earnings were down. So the earnings were down 13% year over year. Apple had a good quarter. Revenues up 16, earnings up 29. Beautiful, right? However, they guided to lower revenues next quarter and then higher expenses, so lower margins. So Apple's under pressure, might be there for a while. Of the stocks that we've discussed, I like Amazon and I like Google. I think those are the ones that own for the long term. And again, a little bit of a pause because they're seeing negative cash flows currently. The hedge fund that blew up is called Situational Awareness. It's managed by Leopold Aschenbrenner. Okay, little side story. I once introduced a handful of very famous hedge fund managers in Europe at a hedge fund conference in Switzerland. And I asked the panel to introduce themselves because their names were just crazy long names that are not like American names, right? And so they insisted I introduce them. So I'll never forget the face of this guy in the audience as I introduced these very famous managers. He was just laughing up as I killed these guys' names. But anyhow, Leopold is 24 years old. He has had a hedge fund at $45 billion, focused on tech, focused on AI, big believer. Graduated from college at 19, so obviously some sort of genius, right? But genius doesn't make you a good portfolio manager. What makes you a good portfolio manager over time is seasoning. That's what really helps a portfolio manager. You may not believe in certain trends and may miss out on them initially, but you tend to be right in the long term. That's what really matters, is that long-term compounding of money, not this big up and then huge down. So obviously Leopold got hit by margin calls, had to liquidate. Citadel Capital came in, bought his book. Ken Griffin, man, the guy has a Midas touch, took advantage of it. And the stocks went right back up, more or less. So he made a nice return on it, I'm sure. But he's probably selling those stocks as they rise here. So we saw kind of this action in the overall markets and thought it was kind of towards the end because these stocks were acting. The S&P came down below its support level, 73.60, came below that, came back above it. That's when you got this washout, and that's when we covered our hedges, our protecting ourselves in this volatile period of time. We still have, August and September in front of us, so we're not jumping up and down bulls, but it seems to be that we washed out the market to some degree, at least in the short term. Hopefully we'll get to 10-year down because of what Trump's doing in the Middle East. Speaking of the 10-year, okay, this is a 5-year chart. You can see where it's peaked out over the last 5 years. 4.9, 4.67, 4.75, currently at 4.69. So got to a little over 4.7% last week. We think we're in the ballpark, if not there already, of the 10-year peaking out. If that would occur, comes down nicely, say into the low fours over time, we can see that these interest rate sensitive stocks or high yield stocks really take off in a nice way, and the overall markets to really broaden out. That's our hope to see at this point. We think technology will be okay because the cycle is still in place. However, having it a very significant part of your portfolio is just not prudent. And heaven forbid, don't do it on margin. Biotech and pharma, okay? And there's another company we like. It's a medical device company, and we'll talk about that maybe in the next couple of weeks. But we have that in our sights as well. It looks really compelling. So AstraZeneca, in discussions with Bristol Myers. It's kind of interesting. So Bristol's got a lot of stuff in their pipeline, but combining the two, you can really cut a lot of cost. But if I was a shareholder of AstraZeneca, and I like the stock, I like the company, the stock's a little expensive, and I've owned it in the past. I would love to own it because it's a good quality growth company in the drug space. And maybe this is a catalyst to own it on this merger and the stock price is coming down together because the street's not buying into it because they're buying a company that's got or merging with a company, Bristol Myers, that has a lot of things coming off patent. What we want to do is focus on major areas of the markets that there's unmet need or innovation happening and very large and growing opportunities. So cancer is always important, right? What we're doing in cancer, we're playing it through GRAIL, G-R-A-L. There's some other companies we like that are developing drugs, but GRAIL has a blood test, works in over 50 different cancers. We think it's highly likely they're going to get approved by year end. Now, the obesity, Alzheimer's, and hypertension space, we think have huge opportunities. Obesity is hot, right? Okay, obesity is now running somewhere around 80 billion in revenues this year, and it's expected to be 200 billion by 2030. Can you imagine the amount of money that Lilly's going to make off their drugs? So here's how it's kind of progressed. This is the GLP-1 market, the obesity market. And so bull case is currently, I think there's somebody out there at 240 billion by 2035. So that might be higher. Even if you take the bear case, this is a huge market. So Lilly has the leading drugs. So what's behind all this is that 40% of the US population is obese, defined by over 30 on the BMI. So that's associated with all sorts of diseases, okay? Type 2 diabetes, heart disease, stroke, hypertension, some cancers. The inflammation is really bad for your body, so you don't want to be obese. And it's really is a bad thing and creates other diseases. So we think that this area is going to be very, very large over time. This is the first generation of drugs. By the way, Lilly reports on August 5th, on Wednesday, We think that Lilly is a core holding in this sector of the markets. Now, Viking Therapeutics is one of our biggest positions. Okay, they are a next generation drug. It's a dual agonist. They believe, and we think they're right, is they will have the best in class drug injectable, and they also have an oral, which is now going into phase 3. So we should get the phase 3 results of the injectables or the injectable obesity drug by the end of the year or somewhere around there. So we would expect that Viking I think it's kind of worst case, but worst case they get 10% of the market until someone else comes in with a better idea. But they have other things in the pipeline as well. Maybe a better drug in the pipeline that's way far back. So currently, Viking has a market cap at 3.7 billion, and the market has identified this as being, has identified this stock with its market cap at 3.7 billion. That's usually a lot higher than what market cap than what we look for. So we're looking for companies that 5 to 10x upside. This company may actually have that. So if you get 10% of a $200 billion market, maybe that's aggressive, by 2030. Okay, so that's $20 billion. You put a 4 multiple on that. That's what we use to value companies. 4 multiple on a slower growing company. So Viking will probably get a higher multiple than this. But put a 4 multiple on that. That's an $80 billion market cap, and it's currently at 3.7 billion. So this happens. This happens in this industry, that these startup companies, they progress kind of slowly over time, get their products developed. They're either acquired or they have the potential to become a very big company. So this company is exciting in my opinion, VKTX. Now, other areas. So Alzheimer's, okay? As you know, we focus a lot on these companies. There's other ones than the two we're going to talk about. But we wanted to kind of give an overview of what's going on there. There's 7 million people in the U.S. that have Alzheimer's disease. 7 million people. 32 million globally. There's 2 drugs approved that are disease modifying from Lilly and Biogen. These are antibodies. They don't work great. They cleared the plaque. So it does improve the cognition, but it's kind of slow in doing it. So they're kind of cleaning out all the bad stuff that's already come in. So it's kind of after the fact, and it slows it a little bit. Bad thing about these amyloid drugs is it causes brain hemorrhaging. So about 25% of the patients have a severe reaction to it, and it could cause death. So what we're looking for in a Alzheimer's drug is something that's on the front end, not the back end. So that cleans the drug, it cleans the toxins, rather, that come into your brain. It cleans it and prevents it from forming all the other issues in your brain. So this is a normal brain. This is a brain with mild cognition, and this is a brain with Alzheimer's. So you want to catch this as early as possible to slow or prevent all these toxins that come into your brain and form this plaque. So Anavex, as you know, has a drug that slows this progression. Now, Alzion is another one. Alzion is private. I wish these guys would go public. It's probably timely for them to do so. But these are the 2 that are on the front end. There's a couple of other companies that we have our eye on that have really interesting drug potential as well. But this is kind of what's in our focus at this point. We've known Alzion now for 12 years, okay? So we really like this company. So we think that how you're going to treat Alzheimer's disease is through a combination of the front end and the back end. So hopefully these companies can get their drugs approved over time for the front end, And we think it's just natural that these companies are acquired by Lilly or Biogen. Hypertension. There are 120 million people in America that have hypertension. Okay, huge market. Nothing new recently. Okay, actually, except for one. And most of these drugs are off patent. And so worldwide, there's 1.4 billion. So this is a ginormous market. So what's not addressed though is that the drugs, the patients that are resistant hypertension, which means that the current drugs don't work. In the US, there's 10 million people that the current drugs don't work on. So this is a very large unmet need. AstraZeneca acquired this type of drug that works on resistant hypertension. Is just being rolled out. We're anxious to see how this works. Mineralys is a $2.5 billion market cap company. They had great data, Phase 3 was beautiful. They're up for approval on they're up for approval on December 22nd. We think it's highly likely they get approved. So 2.5 billion. Again, the markets figured this out. This is a company that's important. We think it's going to be acquired, okay, at a big valuation. So Mineralys, MYLS, think it's really interesting. Retention Pharmaceuticals. This is a private company. They're in phase 2B. Really interesting results. They've done a number of different trials, but now in phase 2B. So they're a little bit behind Mineralys. Again, similar sort of drug. We think when it comes public, we think it will come public in not too distant future, but we think it trades at a discount to Mineralys. So again, like Immuneering, our pancreatic cancer drug, trades at a big discount to RevMed, our VMD. So we think kind of the same scenario is set up where when this company comes public, there's big upside potential in it. So we talked about Anavex last week. Okay, we think, and we said in that on our video and market update that there's 100 times upside in this stock. And so we were asked to clarify that. What does that mean? How'd you get there? Okay, so it's estimated that there's 500,000 people, so 500,000 people in Europe that have early onset Alzheimer's. That's where their drug works best. There's 200 by Mayo Clinic estimated in the US. We think that's a low number. We think it's more like 700,000. And then worldwide, there's another research firm that says there's 3.9 million. So if you just use the 700,000, being conservative, you put probably $20,000 in annual cost for the drug, something like that, right? Gets you roughly $14 billion market potential. You put a 4 multiple on that, gets you about 56 billion in aggregate market potential. Cut it in half. Be prudent about it. Cut it in half. You're somewhere around $28 billion in potential for a company like Anavex. So at a $250 million market cap, there's probably at least 100x upside in Anavex over time, assuming that there's no major dilutions in the shares. But you're probably still going to get somewhere on that 28 billion in market cap. We would assume that there is some dilution, and not sure exactly at this point how that would impact the valuation in the future. But certainly it wouldn't make it a bad investment if there's 100x upside, knowing what we know currently. So if you have any questions, you want to talk about what we discussed, just ping me on my websites, or send me a message off the video. Take care.